We will first look at certain basic concepts. The Income Tax Act extends to the whole of India. India not only includes the territory of India but also its territorial waters and its airspace. The charging section is section 4. And how is income tax charged? By virtue of section 4, the charge is of income tax and it is charged when? In the assessment year. How? As per the provisions of the Act. On what? On the total income. Of which period? Of the previous year. Of whom? Total income of whom? Of a person. And at what rates? As prescribed by the Finance Act. So income tax is charged when? It is charged in the assessment year. Right? What is the meaning of assessment year? The assessment year is a period of 12 months commencing on 1st of April every year. And what is the meaning of previous year? It is the financial year immediately preceding the assessment year. But the concept of previous year gets modified slightly when income is not earned for the whole of the previous year, and there are two situations where business or profession is newly set up. In that case, previous year, instead of beginning with the 1st April of the financial year, it begins with the date of setting up of the business or profession. And where a source of income newly comes into existence, then the previous year begins with the date on which the source newly comes into existence. In both the cases, the previous year ends normally with the 31st March of the financial year. In certain cases, income of a previous year is assessed in that previous year itself, without waiting for the assessment year. And this is called accelerated assessment. Two sections are important from an exam point of view. Section 174 covers a situation where an individual may leave India during the current assessment year or shortly after its expiry, and he has no present intention of returning to India. In such case, income from 1st April of that year up to the probable date of his departure is chargeable to tax in that assessment year. Section 176 covers a situation where any business or profession is discontinued in an assessment year. In such case, income from 1st April of that year up to the date of discontinuance may be charged. So it is in the discretion of the AO, may be charged to tax in that assessment year. On top of this, the regular assessment in that assessment year, of course, happens for the previous year which precedes such year. Now, there are a few sections which govern undisclosed sources of income, but section 69B is important to us, and this covers a case where SSE had made investments or is found to be the owner of what? Of bullion, jewelry, or other valuable article, and the AO finds that the amount spent thereon is greater than the amount which is recorded in the books, and the SSE offers no or unsatisfactory explanation. In such case, the excess amount may be deemed as the income of the SSE. Now, income tax is charged on the total income of a person, and person includes an individual. A sole proprietorship is treated as an individual. An HUF, a company, a firm. Firm includes an LLP, an association of persons or body of individual, local authority, and an artificial juridical person, or AJP. AJP is the residual category of persons. We will now look at the steps for computation of total income. So first we determine the incomes that will enter the computation. So we determine the relevant previous year, and then we determine the residential status for that previous year. Then we determine all items which will be considered as incomes for that previous year in accordance with the scope or the definition of income which is there in section 224. And then we move to section 5 and determine, basis the scope of total income, as to what are the incomes out of these incomes, what are the incomes that will be included within the scope of total income for the relevant previous year. So we include those incomes and we exclude the incomes which are outside the scope. Now, once we have determined the incomes that will enter the computation, we then move to compute the total income. So first we classify and compute the income under the following 5 heads of income: salaries, income from house property, profits and gains of business or profession, capital gains, and income from other sources. This is computed under the various heads after giving effect to the exemptions. So the incomes which are exempt, they are not included while computing the total income. They don't enter the computation. Further, we allow the deductions as available under the provisions of the Act. We club the income with the income of the person as per the provisions of the Act, and we make adjustments on account of set off and carry forward of losses. Thus, we arrive at the amount of gross total income from which we allow deduction from the gross total income under chapter VIA. This gives us the amount of total income which is defined under section 245. Now this is supposed to be rounded off. So total income is rounded off to the nearest multiple of 10. And for this we ignore any paise. And then if the last figure is 5 or more, we increase it to the next higher multiple of 10. But if the last figure is less than 5, then we reduce it to the next lower multiple of 10. Now, should the income be computed on due basis or receipt basis? So it depends on the head of income. As far as salary, income from house property and capital gain is concerned, the method of accounting which is followed by the SSE is not relevant, and income under these heads is computed on the basis of specific provisions of the Act as relevant for these heads of income. But as far as income under the head PGBP and IFOS is concerned, income is computed in accordance with either the cash or the mercantile system of accounting which is regularly employed by the SSE.